how to determine which accounts to tap for your retirement income. Hi, I'm Dave Grant. I'm a certified financial planner and the founder of Retirement Matters, a financial planning company in Barrington, Illinois. Now, after decades of diligently saving and planning for retirement, the hard part should be over, right? Well, after all, accumulating the wealth needed to fund your retirement lifestyle for 30 or more years has to be more complex and strenuous than simply spending it. Think again. The greater challenge is being able to create lifetime income from multiple sources with varying tax implications, often in the face of uncertainty over future tax changes and economic conditions. So determining which accounts and assets to tap at various stages of retirement can mean the difference between enjoying your vision of retirement or struggling to maintain that lifetime of income. There are no simple formulas. Financial planners have simplified at least one aspect of the retirement income equation by coming up with the evidence-based 4% rule. This is the rate at which a retiree could safely take income from their investments without the risk of running out of money. Unfortunately, there is no simple formula for determining which retirement accounts or assets should be tapped because it's based largely on your individual circumstances. These include the exact mix of your accounts you have, whether they're taxable, tax-free, or tax-deferred, your current and future tax situation, and your income needs. There is, however, a less scientific common rule of thumb that advocates for selling long-term assets for capital gains first, with the rationale being that capital gains tax rate is lower than the ordinary income tax rate. Also, as a bonus, if you can manage to keep your total taxable income within the 10 to 15% tax bracket, you won't have to pay any taxes on your capital gains or qualified dividends. By tapping your taxable accounts first, it allows you to continue to compound the growth of your tax-deferred earnings in your 401k or IRAs. In this first stage of generating income, you would also tap into any other taxable savings accounts you've allocated for retirement, with the exception of your emergency savings account, which has a separate purpose altogether. Now, the danger in the common rule of thumb strategy of delaying withdrawals from your IRA is that you would have to increase the required minimum distributions you must take at age 70 and a half. This could potentially shoot you into a higher tax bracket where it could have been avoided. If you have a Roth IRA, you don't have to worry about RMDs, the required minimum distribution, which makes a good case for converting all or a portion of your IRA into a Roth IRA before or early into retirement. Another option is to try and achieve a blend of tax implications by layering the income from different income sources on top of one another. For example, you can take just enough income from your tax-deferred accounts to keep you at your required minimum distribution and add capital gains and taxable interest on top to fill your income need. This strategy requires a constant monitoring of your income sources and your tax situation because the blend of income could change depending on changing circumstances. If you have tax-free accounts, such as a Roth IRA or tax-exempt bonds, you'd want to maintain these for later withdrawals. They can help keep you in a lower tax bracket, especially if you run into RMDs after the age of 70 and a half. As if this weren't enough to manage, there is still the issue of your Social Security benefit, which can be taxed under certain circumstances. Depending on how much income you generate, up to 85% of your Social Security benefits can be taxable. Based on a somewhat convoluted formula, the IRS considers most of your other income plus half of your Social Security benefit in determining how much of your benefits are taxed. Certain types of income are exempt from the formula, such as annuity income and income from a Roth IRA. Now, this is all the more reason to align yourself with a fee-only financial planner like myself, who specializes in retirement income planning because it does get complex. Managing your retirement accounts and deciding from year to year which ones and how much to tap for the most tax-efficient income can be daunting. But with your financial security at stake, it is well worth the time and the effort. That's the end of this video. So until next time, enjoy the day.